Hello. This video explains the stage capital problem that we worked through in class and which you will find in the learning materials for session B1, along with the solution that I arrive at during this video. Now what this is simulating is a highly simplified cash flow statement for a 5-year projections for a business. It's a business that requires some capital investment to allow the sales to grow. So although it's highly simplified, it's not entirely unrealistic. There's some capital investment needed at the beginning and again in year 1 to grow the sales to $1 million a year, but to get to the year 4 and year 5 sales, which represent really rapid growth, an extra $1 million of capital investment is required in year 3. Overall, this amounts to a minimum cumulative negative cash flow of $900,000, suggesting that you need at least that amount to launch the business. And sure enough, if you start off with $1 million, you don't get any negative cash flow or cumulative negative cash flow, and you've got a $100,000 buffer. Question is, in order to secure that funding, how much equity in the business are you likely to have to give up? First of all, we have to establish the value of the business. And a simple way of doing this, which is actually used in reality, but it's a rough estimate of the value of the business, is to multiply its earnings before interest and tax at the end of 5 years by an industry standard price earnings multiple, which in this case we've taken to be 4. Now, as you can see, in year 5, the earnings before interest and tax are $2 million. So I'm going to name that variable, just to keep things clear. EBIT at year 5, that name will do. I'm also going to name the price earnings multiple. And you can see that if you multiply those two together, you get the future value of the business. And let's make that a formula that uses those names so it's clear what it means. EBIT at year 5 times price earnings multiple. Future value of business at year 5, $8 million. Let's say our investor requires a rate of return of 40%. Now that's been put in as a percentage. If I change that to a number, you'll see it turns to 0.4. I'll put it back to a percentage. So what that means, that for every dollar that the investor invests now in year 0, he expects to get another 40% on top of that dollar, compounded over 5 years. So after a year, his dollar will be worth $1.40. After 2 years, it will be worth $1.40 plus another 40%, and so on. 5 years, basically what you're doing is multiplying 1 plus the rate of interest, 0.4, together 5 times, or in mathematical terms, raising it to the power of 5. Now, if you remember, we looked at the compound interest table in the week 1 PowerPoints, and you'll see that at 40%, that comes to 5.38. So let's actually put that calculation in the spreadsheet. What we're doing is we're raising it to the power of 5, and there is an Excel function for that. So let's insert a function. The one we want is called power. Here we go. And you want the number that you're raising. Now that is 1 plus your interest rate and the power you're raising it to. Now in this situation, the power is the number of years over which the investment takes place. In this case, 5. Now Excel's chosen to display this as a percent because one of the inputs into the equation was expressed as a percentage. It's easier to understand that as a number, so let's change it back to a number. 5.38, which, as you remember, matches the number in the table here. So we've worked out the discount. I've called it a multiple, you could call it a discount factor. Basically what it's saying is for every dollar the investor puts in, he expects to get $5.38 back at the end of year 5, or he expects his investment to be worth 5.38 times more than it was when he originally invested, whether he decides to sell or not. Okay, so let's go ahead and calculate what the value of the business is now in today's dollars compared with the future value in year 5. What we do for that is, if we know that each dollar has to be worth $5.38 in year 5, all we do to calculate the value of the business in today's dollars is to divide the value in year 5 by this discount multiple. So let's first of all name that variable, and we'll just call it discount multiple. So all we do is simply say it's the future value of the business. Pardon me, I'm going to name that one as well. Back again. It's the future value of the business divided by this discount multiple. So that gives you a present value of the business in today's dollars of just under $1.5 million. So if you want to verify that that's what we're doing, you look at that and say, okay, if you invested that amount now and you wanted 40% rate of return year on year, in other words, multiplication of your investment of 5.38 times the original amount, you should get to the future value of the business. And indeed you can see that if you multiply this by your multiple, you get back to the $8 million. Okay, we'll take that out. Okay, so what you're asking the investor to do is to invest $1 million in today's dollars into a business which has a notional value of just under $1.5 million in today's dollars. So all you do to calculate his percentage share is divide his investment by the total value of the business. And that gives you 67%, quite a large share. What's left for the founder is the balance of 100%. Now remember, percentages are being expressed as fractions of 1, so that's 1 minus the 67%, giving you a founder's remaining equity share of 33%. So in summary, if you raise them $1 million up front using that valuation method, that implies that the investor would be entitled to 67% of the business based on the amount of money they're putting into it. Now 67% is quite a lot of equity to give up, so you might want to look at other options. Supposing we don't raise the whole $1 million up front, but only as much as we need to get us through to year 3, where we need to make some big investment. As you can see, $250,000 is enough to avoid negative cumulative cash flow, negative cash balance for the first 3 years, and give you a $50,000 safety net. And that would leave you needing another cash injection of at least $650,000 in year 3. So let's assume that we raise the same amount of capital, $1 million, but in 2 stages. First $250,000, and then 3 years later another $750,000. First, let's calculate the first capital raising. The investment amount is $250,000. The present value of the business in year 0 is exactly as we calculated it before. It's the future value of the business, right here, divided by this discount multiple. So once again, 1.487 million. The investor's required equity is the revised investment amount, the smaller amount, divided by the same present value. So naturally, you get a smaller percentage. Let's work it out. With this smaller investment, the investor would only be requiring 17% of the equity in the business, which leaves 100% expressed as 1 minus the 17%, or 83%. that the founder still owns. Okay, that sounds good. So now we move on to year 3, when another 750,000 is needed to fund the capital investment to grow the sales to the higher levels in years 4 and 5, and to allow a little bit of a buffer for contingency. So what we're looking at is another 750,000. But in this case, we're only having to discount back 2 years because we're investing in year 3 based on the future value in year 5. Now there's a big assumption here that in year 3 the business has gone according to plan and the future value in year 5 still holds. But remember, we're projecting into the future here, so we can assume that. So in this situation, because the investment is only for 2 years, you only need to calculate the discount multiple over 2 years. So once again, we're raising the 1 plus the interest rate, which is 0.4, to the power of the number of years, which is 2. So once again, it's the power function, and I'll get it from the menu. Power, our number is 1 plus the interest rate, the investor's required rate of return, and it's over 2 years. Once again, it's expressed as a percentage, and I'm going to change that to a number because it's clearer. And I'll close the formula builder. So discounting the future value of 8 million back to the present value of the business 2 years earlier, you simply divide by that number. So let's take the future value, dividing it by this new discount multiple for only 2 years, and you get the present value of the business in year 3 as just over $4 million. So, what percentage of just over $4 million does the 750,000 investment in round 2 represent? It's a simple division. 750,000 divided by the present value in year 3, 18%. So what investor 2 is doing is investing in year 3 dollars based on the present value of the business in year 3. However, there's a slight problem with this calculation, and that is that the owner, the founder, no longer owns 100% of the business because 17% of the business was sold to investor 1. Now, investor 1 is likely not to want their equity share diluted by investor 2. What happens in this situation is that investor 2's share comes out of the founder's remaining share, out of the 83% of the business that the founder still owns, in this case. So let's calculate what that's worth. What's the present value of the founder's share after round 1? Now, the present value in year 3 is just over 4 million, this figure here. The founder owns 83% of the business, so we simply multiply them together. And this gives us the figure of 3.395 million of the founder's ownership. So to calculate what share you need to give to investor 2, you simply divide investor 2's investment amount of $750,000, year 3 dollars, by the value of the business that the founder still owns in year 3 dollars, this figure here, 3.395 million, and let's see what we get. 750,000 divided by 3.395 million is 22%. So how much of the share of the business has the founder got left? Well, they started with 100%, 17% was sold to investor 1, and a further 22% to investor 2. That leaves the founder with 61% of the value of the business, which is an awful lot better than the 33% he would have had, or she would have had they raised the entire 1 million up front.